How often can I change indexing strategies on an IUL? That is the question I will be answering in this episode. When people ask this question, it usually tells me that they've been watching other educational videos on this channel, and they understand that you don't just select a strategy and sit there forever with that strategy. Yes, you could do that. And people who did that from the year 2000 to 2010, the worst decade since the Great Depression, the Great Recession, we call it, you would have averaged 7.23%. If you had $1 million in your IUL, it would have doubled to $2 million by not doing anything. You just fell asleep like Rip Van Winkle and woke up 10 years later and you doubled your money. But if you change your indexing strategies, which we did with our clients, instead of earning 7.23, they were credited 11.17% during the worst decade since the Great Depression. And they netted over 10% tax-free cash on cash. So get ready. I'm going to explain this in detail in this episode. I think you're going to be blown away. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets and minimize taxes, empower their authentic wealth. If you've watched very many of my videos, my favorite financial vehicle without question is a properly structured, max-funded, indexed universal life. If it is properly structured and maximum funded, it is deemed what I call a laser fund, which is the title of my most recent best-selling book, 300 pages, jam-packed with information and 62 stories. And I'll gift you a copy of this book. It retails for anywhere from $20 up to $70 on Amazon. I'll gift you a copy free at the end of this episode, so stay with me. So usually they're watching these videos and they begin to understand indexed universal life, that the beauty is you're taking the cash values inside of this insurance policy, which will grow tax-free, and you can take out the money tax-free, and you don't have to wait until you're 59 and a half. It's not like an IRA or 401k. It is far superior to that. And if you watch very many videos or read the book, you're going to see that our clients who select IUL, if they did not change the indexing strategies, generally speaking, based on actual historical performance, they will probably average in that 8 to 9% rate of return range, gross, okay? At the end of the day, retroactive back to the first day they open it up, they should net within 1%. Of the gross rate of return. If they average 9, they should net 8% cash on cash. Only 1% went out in the costs that have to be inside of an insurance contract in order for it to qualify to be tax-free in the Internal Revenue Code, okay? Now, again, you can earn 8 and net 7. You can earn 7 and net 6 if you know what you're doing. But if you actually rebalance and diversify, this is the secret behind IUL, is knowing how on an annual basis, in annual reviews, you can take your average return from that 8 or 9% range up to more like 10 or 11 or higher, okay? We've actually averaged 11.17% and netted over 10% for our clients, which means every $1 million that they accumulate, it can generate $100,000 a year of tax-free income without depleting principal. It also means that if you're earning 10%, your money's going to double about every 7.2 years based on the rule of 72. And so we've had many clients who started out their IUL with, $500,000, and it doubled to $1 million, and then $1 million doubled to $2 million, $2 million doubled to $4 million, and $4 million doubled to $8 million. If they didn't need the money yet, yes, we have clients with $8 million tax-free that can generate $600,000 to $800,000 a year of tax-free income without depleting principal. And they started out with $500,000, 30 years before or whatever, okay? And so this is achieved by understanding IUL, structuring it correctly, and then rebalancing and diversifying, okay? So let me give you a few examples. Most of my son's clients, and they have several thousand clients, they diversify within their actual IUL portfolio inside of the same company. Sometimes a client that's repositioning not only hundreds of thousands of dollars, but even millions of dollars, they will request that their money is diversified over maybe 2, 3, 5, or 6 carriers, okay? Because they want to diversify because they're talking about repositioning 10 million, 100 million, or even 400 million. We have people that do that in IUL. The affluent, they understand this, and so they want it to be tax-free. So whatever it is, they're diversifying among companies, but let's just keep it simple and say that you have an IUL with one single insurance company, one particular carrier. Now, most insurance carriers will have somewhere between 10 to 15 different indexing strategies to choose from, okay? You have maybe 1 year point to point, okay? That's where you pick a particular point in time, like the 15th of March, and you link. And 1 year later, in March of the next year, you're going to be credited if the S&P, let's say if you chose the S&P 500 that you linked it to, if the S&P was up, you'll be credited with whatever that increase was over that 1 year point-to-point strategy, okay? And then you can choose another one, or you can just stay and continue with that one for the next 1 year point-to-point. And so you could use a 1 year point to point, but there's other options where you maybe have a 2 year point to point. That means you wait 2 years and measure how much the market went up to see what your credit is. Sometimes there's 5 year point to points. And so if it's a long-term strategy, many times a 5 year point to point is very beneficial if you're beginning to link at the beginning of a downturn in the market, such as 2008. Or March of 2020, because of the COVID-19 pandemic, the market dropped 30%. Why do you do that? Okay, if you are coming on an annual basis to review your IUL, and you can link to a different strategy, and the market just crashed, 20, 30% or more, like 2008, 40%. It may behoove you to at least allocate maybe 50% of your indexing cash value to be linked to a 5 year point-to-point strategy. Why? If you after a downturn in the market allocated 50% of your cash value to a 5 year point-to-point and 50% to a 2 year point-to-point, because you're starting out at a low, historically, you will average over 14% when you do that, okay? So that's pretty good. If you're going through just normal ups and downs in the market, my sons will oftentimes have their clients link 40% to a 1 year point-to-point, another 40% to a 2 year point-to-point, and maybe the last 20% to a 5 year point-to-point. And that's because the average is over 11% for any historical period, clear back to the Great Depression, if you do that one, okay? Now, what you really want to do is be watching for opportunities. So, for example, during the Great Recession, 2000 to 2010, we'll extend it even to 2012, because it took until 2012 for most Americans to come back to break even after having their money suffering up to a 40% loss twice during that 12-year period. In other words, many Americans maybe saved $1 million in their yet to be taxed IRAs or 401ks invested in the market by the year 2000, let's say. Well, without adding a dime, if they had their money in the market, and let's say it was in the S&P 500, they saw that $1 million nest egg dwindle down in value from 2001 after the 9/11 terrorist attacks, from $1 million from 2001, 2002 to 2003. They saw it drop down 40% down to $600,000. Okay. Now, our clients didn't lose a dime during that downturn. They may not have made much of anything if they just sat there with the same indexing strategy linked to the S&P. Zero was their hero, because indexing, your money's not at risk in the market. If you don't understand this, you need to watch several other episodes on this channel. Now, our clients, we came in, they came in for annual reviews, and we came in and said, hey, it looks like people are not going back to work. They're not going out and eating. They're not flying on airplanes after 9/11 terrorist attacks. So maybe you just link over here and get the general account portfolio rate instead of linking to an index here for a year or two. So they only got zero in 2001. In 2002 and 2003, they got 5% instead of zero. Same thing happened in 2007, they got zero, but 2008, they didn't get zero again because there were 5 years that the market was down that you would have earned zero had you not rebalanced or chose different indexing strategies. Our clients only had 2 years of zero. The other 3 years, they got 5%. And then the other 5 years, they got what the market did up to a cap. And only 2 of those years did the market cap out, okay? What was the difference? If you would have had $1 million in there in IUL in the year 2000, and during the next 10 years, you had 5 years you didn't make anything, but you didn't lose. Zero was your hero. And the other 5 years you made money, and only 2 of those years did you cap out, and the caps back then were 16 and 17%, you would have averaged 7.23%, okay? Rule of 72, you divide 7.23 into 72, your money will double in that 10-year period. What I'm saying is people had IUL and they didn't even change the indexing strategy, okay? They just kept it in the S&P 500. If they had it properly structured, their million doubled to 2 million in that 10-year period, where most Americans, by 2010, they still didn't recoup their million. They lost, it took 4 years until 2007 to make back what they lost in the market, that 40% dip in 2001 to 2003. It took 4 years from 2003 to 2007 to come back and get back to $1 million, okay? Our clients were way above that on their IUL. But then what happened in 2008? As Warren Buffett put it, he said, when the tide went out in 2008, it revealed who was swimming naked, is the way he put it. People lost 40% again in one single year for the second time in a decade. It took 4 years from 2008 until 2012 to come back to where they finally had $1,046,800 to show for the million they started with. Many of our clients had 2.5 to 3 million to show for their million in IUL. Now, our clients didn't sit there and earn just 7.23 because when they came in for annual reviews, 3 of those 5 years, they didn't get zero, they got 5. So they went up to 11.17%. But then we rebalanced. And so many of our clients, they ended up averaging 11.17% during that period. And so if you go clear to 2012, many of them had 2.5 million or more in their IUL, where most Americans who had their money in the market barely had their $1 million back. Does that make sense? Okay. Now, there's other times besides linking or just going back to the general account portfolio rate that you may want to link to another one based upon is the market down or whatever. So there is another strategy that we generally don't use during normal times, and that's called a threshold strategy. What is that? That means there is no cap. You choose a no cap strategy. So instead of having a cap that if the S&P is up, 10 or 12 or 15 or 17%, if the cap is 10 or 12 and the S&P is up 15, you don't get 15, you only get 12. That's called a cap. Now, the trade-off is if the market crashes, you don't lose, but they cap it, and that's because of the price of options and what have you. Now, if you remove the cap, okay, then there are other costs, and the insurance company has to buy options in a different way. So if you remove the cap, then there is a cost to that, and generally that is going to be subtracted off of the return that you're credited. If they take the lid off, there is no cap. And so they may deduct 5% or 7% off of whatever your return ends up being, okay? Now, in a normal period of time, we don't do that because normally our clients might average 11%, okay? So if you used a threshold strategy during just normal up and down times and you got credited 11 and they subtracted even 5%, then you're only going to net what? 6. And so we normally don't choose that except during certain times. So one of those times happened in March of 2020 during COVID-19. So the market dropped 30% in one single month. Now, my 2 sons, they contacted over 800 of their clients who had money in their UL policies that were ready to be linked. And they said, link to a 1 year point to point with no cap, with a 5% threshold fee. Okay. And they did that with one stroke of their computer and contacting their clients. So what happened? The market, of course, rebounded. They knew it had a very good chance of doing that. So from March of 2020 to March of 2021, the market, the S&P, was up 66.33% from the low in March of 2020 during COVID-19. So they had 66.33 minus 5 percentage points. They netted 61.33%. Yeah, we had over 800 clients that got 61.33%. One client had 852,000 in his IUL policy that he allocated to that strategy. That was only about 20% of his money in that IUL, by the way. A year later, in March of 2021, that 852,000 was now worth $1,382,000. He made $535,000 tax-free in one single year. Now, if the next year the market would have crashed, he wouldn't have lost one dime of that $535,000 he made the year before, because you lock in your gains and reset. If you don't understand that, check out another episode where I talk about lock in and reset. But the point is this: you can change indexing strategies every time you get to the end of an indexing linking period. Or if you're just riding along at the general account portfolio rate of the insurance company, you can link it any time you want. But if you link to an index, you've got to wait till the end of that indexing period. If it's a 1 year point to point, you have to wait till the end of that 1 year to see what you're going to be credited for that year. And then you link to a new one, okay? And so you can change the strategy at the end of each indexing period. And so when you understand this and you have an IUL professional who knows what they're doing, you will be able to tweak your rate of returns so that your average gets to be like our clients in excess of 11%. And we have many clients that have done way more than that, but you want to earn 11. And at the end of the day, you want to net within 1% of the gross rate of return. Our clients net about 10.07 cash on cash after all the costs of the policy. 10% divided into 72, your money's going to be doubling every, 7.2 years. It's that simple. So hopefully that helps you understand that you can change indexing strategies as often as every single linking period every year. And that's why we strongly encourage that you have an IUL professional that understands this and reallocates, rebalances, and diversifies every time they meet with you for an annual review. Now, if you want to learn more, I would strongly recommend that you study my book, The Laser Fund, co-authored with my two sons. This retails for anywhere from $20 to $70 on Amazon. I'll gift you a copy free. Simply click on the link below, or you go to laserfund.com and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, but I'll pay for the book. I'll fire out a hard copy of this to you via priority mail. Now, when you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, there's audio and video formats available. You can even register for a free educational webinar. We do 90-minute webinars on a regular basis, and about once a month we do 6-hour Retire by Design webinars. You can even schedule an appointment to talk to an IUL certified professional that will show you how an IUL laser fund can work in your particular set of circumstances with no cost or obligation. Because if you don't get it structured correctly, you're not going to be able to take advantage of what I've been talking about in this episode. Now, this is not about me, this is about you. And so this book has 14 chapters on this left brain side with charts and graphs and explanations. If you're more of a right brain learner, you flip it over to this one. And this has 12 chapters with 62 actual client stories. So study, learn, claim your free copy, and engage, because you're going to kick yourself. You're going to miss out if you don't seize this opportunity.